Curious about what really moves the crypto market and how it affects the wider financial world? You're in the right place. In this video, we're breaking down the key economic factors behind crypto and how they impact the bigger financial market, helping you understand the forces at play. Before we dive in, don't forget to like, subscribe, and hit the notification bell so you never miss straightforward insights that make complex topics easy. Let's get started. Market capitalization and liquidity effects. The total cryptocurrency market capitalization has grown to represent a meaningful share of global financial assets, making it increasingly relevant to the broader financial ecosystem. As a result, crypto markets no longer operate in a vacuum. Their performance can now influence and be influenced by traditional markets such as stocks, bonds, and commodities. When there are major swings in crypto prices, especially in large-cap assets like Bitcoin or Ethereum, the ripple effects often extend beyond the digital asset space. This is especially true because many large institutional investors, such as hedge funds, asset managers, and family offices, now hold diversified portfolios that include both crypto and traditional financial instruments. When volatility hits one side of the portfolio, these investors often rebalance to manage their overall risk exposure. For instance, a sharp crash in Bitcoin may force institutions to sell off equities or other liquid assets to meet margin requirements or cover losses, potentially putting pressure on traditional markets. Conversely, a rally in crypto may lead to profit-taking and reallocation of funds, which can impact the flow of capital in other sectors. This interconnectedness increases the risk of contagion, meaning financial stress in one market can spread to others. During periods of global uncertainty, such as inflationary shocks or geopolitical events, crypto volatility can amplify broader market stress by adding another layer of risk. Since crypto markets react immediately and around the clock, they often serve as a real-time barometer of investor fear or speculation. Liquidity plays a major role in this dynamic. Although the crypto market has grown tremendously, it still lacks the deep liquidity found in well-established markets like Forex, US Treasuries, or large-cap stocks. In traditional markets, it takes very large trades to significantly move prices. In contrast, in crypto, even moderately sized transactions can create large price swings, especially in smaller or more volatile coins. This low liquidity also makes crypto markets more vulnerable to slippage and manipulation, where large orders can distort prices and trigger cascading effects like liquidations on leveraged positions. Institutional adoption and corporate treasury impact. Major corporations adding cryptocurrency to their balance sheets has fundamentally changed how business risk is assessed. Companies like Tesla, MicroStrategy, and Square have allocated significant portions of their cash reserves to Bitcoin, making their stock prices partially correlated with crypto performance. This corporate adoption creates a direct transmission mechanism between crypto volatility and traditional equity markets. Institutional adoption also affects monetary policy transmission. When major financial institutions offer crypto services or hold crypto assets, central bank policies may have unintended effects on cryptocurrency markets. Interest rate changes that traditionally only affected bonds and loans now also influence crypto lending rates, staking yields, and institutional crypto investment strategies. Regulatory environment and policy uncertainty. Regulatory announcements from major economies create immediate and significant impacts on both crypto and traditional markets. When China banned cryptocurrency mining and trading, it didn't just crash Bitcoin prices, it also affected semiconductor companies, energy markets, and even geopolitical relationships. Similarly, positive regulatory developments like Bitcoin ETF approvals in the United States have boosted not only crypto prices, but also financial services stocks. The regulatory environment creates policy uncertainty that extends beyond crypto itself. Traditional financial institutions must now consider crypto regulatory risks in their business planning, affecting everything from bank lending policies to insurance underwriting. This regulatory overhang influences market confidence and investment flows across multiple sectors. Decentralized finance and traditional banking disruption. DeFi protocols have created parallel financial systems that offer services traditionally provided by banks: lending, borrowing, trading, and yield generation. This isn't just competition, it's fundamental disruption of banking business models. When DeFi protocols offer higher yields than traditional savings accounts, they create pressure on banks to adjust their interest rate policies and service offerings. The growth of DeFi also affects monetary policy effectiveness. Central banks rely on commercial banks to transmit monetary policy through lending rates and credit availability. However, DeFi protocols operate outside this traditional framework, potentially reducing central bank influence over economic conditions. This creates new challenges for financial stability and economic management, cross-border payments, and currency sovereignty. Cryptocurrencies' use in cross-border payments challenges traditional correspondent banking systems and foreign exchange markets. Countries with unstable currencies often see increased crypto adoption, which can affect their exchange rates and monetary sovereignty. When citizens use Bitcoin or stablecoins instead of local currency, it reduces the effectiveness of domestic monetary policy and can accelerate currency devaluation. This trend particularly affects emerging market economies, where crypto adoption rates are often highest. The ability to easily convert local currency to crypto and back creates new capital flight mechanisms that can destabilize exchange rates during economic stress periods. Energy markets and environmental considerations. Cryptocurrency mining, particularly Bitcoin, consumes significant amounts of electricity, creating direct impacts on energy markets. Mining operations can affect local electricity prices and grid stability, while also influencing investment in renewable energy infrastructure. Some regions have experienced power shortages, partly attributed to crypto mining demand. The environmental debate around crypto has also affected ESG investing trends, influencing how institutional investors approach both crypto and traditional energy sector investments. Companies involved in crypto mining or services may face ESG-related investment restrictions, affecting their access to capital and market valuations. Stablecoin integration and monetary system changes. Stablecoins represent over $150 billion in market value and serve as crucial infrastructure for crypto markets, but they also interact with traditional banking through their reserve backing. Major stablecoins hold billions in treasury bills and bank deposits, making them significant players in short-term funding markets. Changes in stablecoin demand can affect treasury bill prices and money market conditions. The integration of stablecoins into payment systems also creates new monetary dynamics. As businesses and consumers use stablecoins for transactions, it can affect the velocity of traditional money and the effectiveness of monetary policy tools. That's a wrap on crypto economics and its impact on the financial market. Knowing what drives these markets can give you an edge and help you make smarter decisions. If you found this useful, give it a thumbs up and share your thoughts or questions in the comments. And be sure to subscribe and hit the bell for more easy-to-understand finance content. Catch you in the next video.